All right, yield nerds, we are on to a very exciting and scary week at the same time. I feel like this should be named The Day After Tomorrow, a movie from a couple of decades ago where the world freezes over and we figure out what the next best actions are. So hopefully that is not going to happen and we're going to come out of this debt ceiling crisis. But I thought I would lay out a couple of things, possibilities, paths, and see where we go from there. A couple of housekeeping things. New subscribers, if you're jumping into this episode and this is the very first time or one of the first few times, there is a video called How to Navigate the Channel. There is a roadmap, which is a playlist. So consider using that and you can go through the channel in a more thoughtful and methodical way. My disclaimer, I am not a wealth management advisor. I don't care whether you do what I'm discussing or not. I don't have any kickbacks, t-shirts. I do not endorse product or politics. All right, today's episode is going to be focused on what happens if there is a deal, if there isn't a deal, what happens if there is a deal in 3 days, 5 days, 14 days, and things that I thought would be very useful for us to keep in mind. And hot off the press, nobody knows what the exact X date is. And literally 20 minutes before, there was an article that said, Secretary Ellen now says the new X date may be June 5th and not June 1st. And that is based on some moving parts. And realize that June 15th is the deadline for corporate taxes to be paid. And if some companies pay a giant cash bill ahead of June 15th, and maybe some of them will, maybe some of them won't, then that gives more runway. What it also means is there is more time to debate and not compromise. So the odds of anything getting done before June 5th, I would say, are unfortunately pretty slim. So speaking of odds, let's play the game of odds. What is the likelihood that there will actually be a 2-year solution? And I know we're talking about it, but it's still with the heads of the parties. It hasn't gone to the House, it hasn't gone to the Senate. So all of those hoops to be crossed between now and June 5th, I still don't think it's a gimme. At the same time, the odds that people would just sit and watch the house crash and burn is also extremely slim to none. In all likelihood, there will be some kind of a compromise that kicks the can to July 15th or June 15th even, because the estimated taxes come in or the corporate taxes come in. And there is still a very real possibility that one payment or another will get missed right after June 5th. And that is my humble opinion. I'm not suggesting you do or don't do something based on odds. That's not how we operate. Just based on where the temperature is and the possibility for people to compromise, it unfortunately doesn't look like the environment is conducive for compromise. Having said that, what is the market doing? So let's look at that. Ironically, we talked in the previous episode about how you should hold cash and move some of it away from the market. That is exactly what the market is doing, with several more zeros attached to it than you or I. Notice what is happening. This is from the and the months and dates are upside down because this is from a British website. So 3-5 is really 5-3, and this is 5-10, and so on. So the month of May, as you can see, the green bar is very high, meaning money is going in to money market accounts and out of equities. Now, you can read the news and say this AI stock did well and that AI stock did well. And again, that is one of thousands of equities. But in aggregate, money is leaving the equities market and it is going in a hurry to money market accounts, because in the event that the Fed can pay, the money managers don't want to take that chance. They're moving it into cash. So that is something that is happening for real. And then specific to equities, the sector that is having the highest outflow, and once again, this is the month and the date are reversed, and financials are seeing a very large draw out. And as I said, there is a small blip in IT, some new money coming in, but in the grand scheme of things, that really is not what is happening. People are pulling their money out of the market in a hurry. Another thing that appears to be happening, if you look at bonds, corporate bonds are suddenly seeing an uptick, and there is a very simple reason why. If you are afraid that the Fed will not pay what it is supposed to pay, and you are a money manager and you want to make, some kind of return in the next few weeks, then you're going to go buy corporate bonds that are maturing in short order and say, well, I know they are going to pay because they don't want to default. And so there is some of that happening. The returns are much worse than what the government would pay. And obviously, as you can see, there is also money coming in to the government bonds. And it's a head scratcher. You sit there and go, wait a second, why is money coming in there? And there is an explanation to that, and I'll walk you through that in a second. Um, High yield bonds are seeing a whole bunch of cash outflows, as you can see. And so the question then is, why is this happening? And how is Wall Street preparing if indeed there is a default? What are adjustments being made? There is an excellent article in Reuters. Here is the headline: Wall Street prepares for Treasury's mess. And so, what is the workaround? One of the things that has been proposed, and this was done before in 2011 as well, is assume for a moment that a certain Treasury note or a bill comes due on June 1st or June 6th or whatever it is, and the government is not able to pay it. What they would do is roll it over, so to speak. They would say, well, the real maturity date is no longer June 5th, it's June 6th or June 7th. And one day at a time, the government would start paying the interest or accruing the interest to be paid. So if you owned a 5% security that matured on June 5th, and somehow the government did not have the money to pay you on June 5th, they would pay you whatever is due for that security as of June 5th, plus one more day of interest on June 6th or 7th, or whenever it is the debt ceiling deal is done. What that means is if you pick up a security now that matures in a week and there is a blip, the odds of your making whole is very, very high. There is already a contingency plan there. So the money managers have to update their systems so their bondholders don't freak out, and the government has precedent to do that as well. So then the question is, what is the most logical sequence of events that would happen whether or not there is a deal? Well, let's assume there is no deal by June 6th. And as I said, there's a reasonable possibility, whether it's 20% or 2%, it doesn't matter. If it drags on past June 6th, then we may be faced with some kind of federal spending, where they are not able to pay. Whether it will roll over to maturities or not, I don't know. However, if it does, the odds of you are never getting paid are slim to none. I would imagine that equities will have a big blip at that point. When this happened in 2011, equities fell by 16%. And you can do your research on that. It's pretty wild what happened. And so if by June 6th there isn't a deal, there is a pretty good chance that there will be an equity crash. You have to imagine if the flight to money market accounts continues, it's already happening. When the equities are getting sold, that money will find itself in banks, and there would actually be an increase in the cash balance in banks. So if indeed we cross the 6th and go to the 13th, and now all of a sudden people are getting this huge bank balance, however, the actual bank balance of the American government is very low. That is why we have a debt ceiling issue and a default. So the government has to replenish its bank account. How does the government replenish its bank account? It issues a huge amount of treasury bonds. Remember all this money that went into money market accounts? That is going to come pouring back into the treasury market. When it comes pouring back into the treasury market, there will be a run on cash in the banks. Ironically, it will create a week up and a week down effect when that happens. And interest rates, in all likelihood, I'm guessing, I don't know, would go up because inflation is high, the market is hot, jobs are still getting created. And then the question is, what happens in the worst case scenario where June 15th comes and goes and we still don't have a deal? Remember that the government will have tax receipts by that time, estimated taxes get paid. However, it is likely to rattle the equity and the bond market, and people may not even feel comfortable leaving money in the bank. It's a terrible, terrible scenario. And so if we don't have a deal by June 15th and the government is in default, it may create a really big blip. Now, what would the FOMC do on the rate setting meeting on June 13th is anybody's guess. But if for whatever reason they said, ooh, the government is in default, and so we're not going to increase it, we're going to leave it as is, it still gives a pretty solid payable around 5.5%. And as I discussed, it is my humble opinion, and based on what the market has done in contingency planning, that you will get the money, it just is going to get extended. So there may be an opportunity to buy bonds right around June 15th, but buying it between now and then, I would be measured about it. So there are ways for the government to take cash from one department and put it into the other. So let's look at what happened in history. Deals do get done in the very last minute. I hate to say it, it's not a political statement, it's about both parties. They have to prove to their constituents that we fought for you. I know I did not give up your number one priority. Look what I did. And so they both will, claim victory, and there will be uncertainty. Now, what happens to treasuries during this time? Here is the irony of it. And there is an article called Treasuries Still Attract Investors Even in a Default. And I would encourage you to read that. It is shocking but true. And in the scenario where the US is saying, we can't pay, but trust us, we'll eventually pay, there are funds in the market that have philosophies that say X% of their money will be in AAA bonds or high quality bonds. And granted, the credit rating could go down and it might affect it a little bit, but by formula, analytical trading will still put a ton of money in the United States treasuries only because there just isn't enough good debt outside. Let me tell you what I mean by that. If the US credit rating goes from AAA to AA plus, well, then there is something of the order of 27 trillion of debt that has to find a home. And you can say, oh, Germany has a really good credit rating. Let me go buy. Well, that's only two. After Germany, there is nobody else that is close. Well, Canada only has 1.7 trillion of money that you can buy. So the market is just going to buy up what is there, and they will be stuck, and they still have to buy US treasuries. And so the history says the United States treasuries will still be the safe haven, even if there is a default. And so there is no reason to dump treasuries and run. At least that's my opinion. You do what you want to do. And the irony is that when the debt ceiling issue is resolved, there will be a flood of new T-bills that come. Here is an article from Business Insider. Please Google it and read it. Very, very good article that says if you just wait, there will be another buying opportunity at an even higher interest rate. And so the real challenge is what happens if there isn't a deal, and how can you be smarter about it? What I would suggest, and this is what I am doing, is there is a small possibility that the deal gets done. However, it may get done after June 5th, and securities right on the June 5th mark are trading at an insane yield of 6.3%, which is kind of like 7% pre-tax because state taxes are exempt. And you may want to hold on to a healthy amount of cash and wait for the market collapse if there is one. If there isn't, you can always put the cash to work because there will be plenty of supply of new treasuries as we saw. But the street smart thing to do to prepare for a default may well be that, if you have military families, unfortunately, the most patriotic people, the old, they may be the first ones to get affected. So you may want to have some cash on hand, maybe a couple of weeks worth of cash flow. Just keep it, at home in a safe place. There may be a big dip coming. We don't know. We hope the disruption is not high, but let's be smart and think through whether you want to have some money under your mattress, figuratively. Hopefully you have a much better place to put it. But that is something you may want to know. And on a positive note, inflation does appear to be getting tamed in some sectors. The economy is cooling off. We do see no news about layoffs here and layoffs there. The Fed may pause rates in the coming months as long as inflation comes down. They seem to be set on tackling inflation. Until then, it still seems, given all the risks, it still seems that short term treasuries are the best bet. Long story short, just sit tight, wait for the storm to pass. That is what I intend to do. Thank you for listening to Yield.